Hi everyone, in this video I'm going to answer if Tesla's 55% stock price drop year to date in 2022 is justified. I'm going to look at a few different metrics to consider this question, and I'll have the answer for you by the end of this video. So getting started, 55% down is a huge drop off for any company, but it's a little bit understandable for any of the EV stocks. They're more risky than your average stock, so it's more likely that an EV stock would experience a significant drop off compared to the average stock in the market. So let's look at the first thing I'm going to look at is Tesla's revenue growth. And going back for the last 3 years, and you know what? I'm going to extend it to the last 5 years. Going back to the last 5 years, we see its revenue growth has fluctuated, but kind of on average has stayed around the 50% range. If we look at some of the quarters were way above 50%, some of the quarters were below that range. But if we look going back, the number of quarters above 50% and the number of quarters below kind of average out. Most recently, that growth was at 56% in its most recent quarter, but the trend here is going downward. But the interesting thing about this most recent slowdown in revenue growth is that it's coming at a time when competition is really ramping up. For the most part of the last several years, it's been Tesla alone in the EV market. There's been a few other cars coming out, but it's been primarily Tesla. That's not the case in 2022. Several companies are now producing thousands and thousands of units per quarter, and that's starting to crimp into the outlook for Tesla's deliveries going forward. Are customers only going to go to Tesla now that there are so many other viable options from Rivian, from Polestar, from Lucid, from Neo, from others? And because of all of these availabilities, some customers are going to prefer those other models. There's other choices now if you want to get an EV instead of only a Tesla. And so it's not just the slowdown in growth rate that has investors concerned about Tesla, it's also the rising competition that's coming at the same time as Tesla's growth is slowing. That's giving fears of investors thinking, hey, maybe this slowdown is more persistent this time. Maybe Tesla is not going to bounce back and accelerate its revenue growth. Will it or will it not remains to be seen, but definitely the risks are higher now that competition is rising. Another metric I'm looking at now is the gross profit margin quarterly. And going back to several years, and this is something if you've watched my other videos, I've really commended Tesla on doing an excellent job of delivering economies and scale in their gross margin. As they've sold more cars, expanded manufacturing, they've increased their gross profit margin over the years. So I've said it several times. Kudos to Tesla for this, and they are the best in class in the EV industry in terms of gross profit margins. Nobody, I think the second closest is at 18%. So Tesla is ahead of the game here. But that said, its gross profit margin has declined. And there is a risk that, again, that this will continue to decline or at least stop rising as it needs to now compete with several other large car manufacturers for materials and supplies and labor. So it's going to increase Tesla's costs. And if it has to pay higher prices for materials and labor, that means Tesla has to make a difficult choice. Is it going to raise prices on its cars, which is going to decrease revenue growth? Or is it going to absorb the higher costs and sustain a lower gross profit margin? It has to pick one or the other. It can't have both here with the rise in competition, and they're buying the same materials. They're competing for the same materials. And so this is not good news for Tesla stock investors. And that could partly explain, again, why the stock is down so much in 2022. All right, the next thing I'm going to look at is Tesla's cash flow from operations. And in this regard, I'm not seeing any evidence of trouble. Looking at its cash flow from operations going back to January 2020, you see a steady increase upwards of 5 billion now in its most recent quarter. So very healthy cash flow generation, and that cash flow generation is increasing. And but still, risk the challenge from competitors is going to pressure these cash flows also. It may just be a couple quarters down the line that this cash flow from operations may be impacted, but it could still get impacted because of the rise in competition. All right, the next thing to look at is Tesla's earnings per share. And recall, Tesla only recently became profitable. It for the longest time it was generating negative profits on the bottom line, but steady increasing throughout 2021. But in 2022, it kind of flatlined. Earnings per share fell in the second quarter and then bounced back up a little bit in the third quarter, but it was still flat compared to last year, the same quarter. And so that's another troubling trend is your revenues are soaring on the top line, but at the same time you're not you've stopped expanding earnings per share, and that again connects to the stable but falling gross profit margin and a concern for investors in this regard. And then finally, looking at valuation, not just the stock price, but looking at what you're getting for the price you're paying, your price to earnings ratio. And that has fallen significantly. Arguably, it should never have gotten up to these sky high levels in 2020 and early 2021, selling at over 1,200 PE ratio. It's gone down to more realistic levels at a PE ratio of 48. So relatively speaking, it's gotten more favorable, the pricing, but it was way too expensive. And even a PE ratio of 48 is not cheap. That's not cheap for a company that's experiencing the headwinds that Tesla is experiencing right now amid fierce competitive entries into its industry. And these rivals, they've all got billions of dollars. If you think about Rivian and Neo and Lucid, they all had billions of dollars of injections, capital injections. And so they're going to produce these cars. They're going to compete with these materials. They're not going away anytime soon. So this is, to be paying a PE of 50 for a company that's in the middle of that, I don't know. I don't know about that. So you can understand again why the price has fallen. And then looking at the price to free cash flow of 61, it looks even more expensive in this regard. And then also if we go back before the hype of 2020, recall 2020 is really when the hype of Elon Musk and Tesla really exploded, which caused the stock price to inexplicably explode higher without really the fundamental backing behind it, or at least not as, way beyond the fundamental backing that was supporting it. Yes, the company was growing revenue and profits and cash flows, but the stock price was growing beyond what those figures justified. And so at 61, it's about the same level it was trading at before the hype infused rally in 2020 began. So it's back at where, I feel like the price should have been to begin with. I don't think it should have soared all that much. And so, to answer the question in the video, is Tesla's 55% stock price decline justified? I would say yes, it is. It was due for a pullback. The stock had gotten ahead of its skis, ahead of the fundamentals, and it was due for a pullback. Now, that's not to say that Tesla's not doing an excellent job. It's the best in class EV stock, expanding, economies in scale, cash flow from operations, everything really, really good, not taking anything away. It's just, that was arguably more than priced into the stock already. It was, yes, it was doing really good in terms of the fundamentals, but the price was far ahead of that. So a decline, yes, was justified, and a pullback was due. Okay, so that's all I've got for this video. Thank you for watching, and I will see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.